For more than 75 years, the Federal Deposit Insurance Corporation has kept money in America's bank deposit accounts safe and sound. But what happens when a bank fails? The FDIC has two jobs. 1, protect all insured deposits. And 2, dispose of the bank's assets, which are mostly loans. They come in many shapes and sizes. If the FDIC doesn't sell these assets at the time of failure, it must take them over and manage them until they can be sold at a later time. And because of uncertainties about future losses on those loans, buyers are unwilling to pay much for them. So the FDIC has a less costly way to move them at the time a bank fails. It's called loss sharing. Here's how it works. Let's say Orchid Bank wants to acquire the failed Beige Bank, but it is hesitant about the risk in certain loans in the portfolio. The FDIC enters into a loss-sharing agreement with Orchid Bank to cover a portion of the losses on those loans. Orchid will assume all of the deposits of Beige Bank, $100 million, and all of the loans, valued on the books at $100 million. The book value is what Beige Bank invested in these assets, but they are not worth that now. After all, the bank did fail. With loss share, Orchid Bank will pay more for the assets than the FDIC could get by selling everything on the open market. And by buying all the assets, Orchid Bank is minimizing the FDIC's losses. Loss sharing benefits Orchid Bank by protecting it from the trouble that caused Beige Bank to fail. And it benefits the FDIC, which gets a higher price for the assets by providing some certainty to Orchid Bank about what its maximum losses will be. An added benefit to the FDIC is that loss share reduces the amount of cash the FDIC must expend to make depositors whole. If the FDIC couldn't find a buyer for Beige Bank, it would have to take $100 million out of its fund to pay Beige Bank depositors. But with Orchid Bank acquiring all deposits and assets, the FDIC's outlay is significantly lower. And because Orchid Bank is doing all of the customer service on the loans and bank accounts, the FDIC saves again on the costs it would otherwise incur in collecting loan payments and other costs of carrying the loans. Bank customers also benefit from loss sharing. Their deposits and loans stay in the same place, so the customer banking relationship is preserved. As for making big profits on reselling assets, the loss-sharing agreement stipulates what Orchid Bank can and cannot do with those acquired loans. For example, Orchid can only sell them after a certain period of time, and even then, only with the FDIC's approval. And if the bank incurs no losses on the assets, the FDIC makes no loss-share payments. Orchid Bank is also required to implement a government-approved mortgage loan modification program with the goal of keeping people in their homes. If Orchid takes a loss on the modified loan, the FDIC will make a loss share payment to cover it. But if modification isn't possible and Orchid forecloses on the loan, the bank gets no loss share payment until the home is sold, and even then, only if there is a loss. The FDIC also carefully audits every loss share agreement. Loss sharing helps the FDIC minimize outlays and maximize returns to its fund. It keeps assets in the private sector instead of under government management. It protects acquiring banks from losses. Most importantly, it helps local consumers and businesses by keeping the assets of the failed bank in the community, preserving banking relationships for customers who had both deposits and loans in the failed bank, and keeping people in their homes wherever possible. By sharing the loss, many gain.